Group Head Financial Sector Ratings at ICRA joining in. Let me just actually get you what ICRA is saying in its latest report, which has actually been widely tracked. They're saying that over the next 12 to 18 months, around 65% of the loans which are under the SDR restructuring route are essentially going to fail. They're going to fall into the NPL category. That's what they're saying. Thanks very much for joining us on the show, Mr. Srinivasan. Could you just explain the rationale behind that thinking briefly, sir?
No, one just wanted to correct. We're not saying that these loans are going to fail. What we've tried to highlight is a lot of these accounts had undergone an SDR over the last 12 to 15 months, and as per the regulations, the asset classifications would continue to remain for a period of 18 months, which is called as a standstill clause. Unless these accounts are resolved, one of the part of the SDR was to get in a new buyer or a new investor into the scheme of things to revive those accounts. What we've highlighted is, in case that were not to happen, I mean, we've seen very limited successes so far, at least as of the reports which are available till now. So in case this was to continue, then potentially after the standstill clause ends, which could be starting anytime March 17 to next financial year, to the current financial year, a lot of these accounts asset classification may need to change from standards to NPA. In that context, the reported gross NPLs could increase quite sharply over the next 12 to 15 months.
Mr. Srinivasan, but you are putting out a number, right? You're saying you go quarter by quarter, and you say that ICRA's estimates are there's about 1.57 lakh crores out of the 2.45 lakh crores which can slip into the NPL category, right? So that's a very precise estimate. That's why I began by saying about that's about 65%. Go on, sir.
No, correctly. That's what I'm saying. In case these resolutions do not happen, then as per the time frame on the standstill clause, we could definitely see this quantum slipping into NPL category. So to that extent, you're absolutely right. It's what we projected in our note as well, based on when these accounts first entered into SDR, an 18-month period from then. That's the kind of a vintage analysis, or the expected quarter in which they could slip into NPLs is what we've shared in our note.
Okay. Sector-wise, which would be the sectors which might see the slippage from SDR to NPAs?
I think if you see the metals, construction, power, these have been the three largest segments, accounting for almost 2/3 of the overall portfolio, and broadly evenly split. So these are the sectors which we feel are most vulnerable unless some real resolutions happen. So these are the broad three areas where the slippages could really happen.
Just a quick question. You're projecting the NPAs to go up all the way to over 66,000 odd crores by Q4 of FY18, so by the end of next fiscal. So have you done any work in terms of what the bank's bottom line could look like if you're factoring in a higher gross NPA plus a higher provision?
We estimate that the bank's bottom line would remain subdued. Again, one needs to split it up into, at this stage, into public sector banks and private sector banks. Our estimate is the credit costs are likely to remain at fairly elevated levels. In most of the cases, the credit cost could be higher than the core operating profits of these banks. And unlike FY17, where banks did have the benefit of a falling interest rate, which led to higher treasury gains, which may not be available in FY18. So accordingly, our estimate is, you would still have quite a number of banks possibly reporting losses, public sector banks in FY18, or very close to negligible profitability. Our own estimate is we are looking at a 0 to 3 or 4% ROE for public sector banks. Private sector banks could still continue to report slightly higher ROEs, maybe in early double digits. Again, even they would be bogged down by the credit costs, which continue to remain high and likely to remain in FY18 as well.
Mr. Srinivasan, thank you very much for getting us the essence of that report. I mean, I think it's a